Welcome to this comprehensive guide on the poor man's covered call, a sophisticated option strategy designed for superior capital efficiency. In today's presentation, we will explore how this strategy utilizes long-term equity anticipation securities, or LEAPs, to mimic traditional stock ownership and generate consistent income, specifically illustrated through real-world examples involving Meta and Microsoft. To begin, let us define the poor man's covered call, technically referred to as a long diagonal debit spread. This strategy serves as a surrogate for a standard covered call, but at a significantly reduced capital requirement. Instead of purchasing 100 shares of a high-priced equity, the trader buys a deep-in-the-money LEAPS call with a high delta of at least 0.80. Against this long position, short-term, out-of-the-money calls are sold to generate recurring premium income. The core mechanics of this strategy are straightforward yet powerful. By purchasing the LEAPs, you establish a leveraged long position that acts as your synthetic stock. By selling short-term calls, you are essentially collecting rent on that position. It is important to note that the net debit paid represents your absolute maximum risk, and unlike traditional covered calls, no margin or actual stock ownership is required. Let us examine our first case study, Meta Platforms. At a current market price of approximately $688 per share, a traditional covered call would require an investment of over $68,000. In contrast, the poor man's covered call setup we are discussing requires only $17,050, representing a remarkable 75% reduction in the capital necessary to control the same number of shares. In this MetaTrade setup, we purchase a 550 strike call expiring in January 2027 and simultaneously sell a 725 strike call expiring in roughly 45 days. While the reward is optimized as the stock moves toward the short strike, the primary risk lies in a significant price decline. Should the stock fall below our long strike by expiration, the total net debit of $17,050 would be at risk. Our second example focuses on Microsoft. With the stock trading at roughly $422, the cost to own 100 shares outright exceeds $42,000. By utilizing the poor man's covered call strategy, a trader can establish an equivalent position for just $10,450, again achieving a 75% savings in capital allocation. For the Microsoft trade, the income potential is substantial. By collecting $750 in premium every 30 to 45 days, a trader could potentially generate up to $7,500 annually. A critical technical check here is the spread width. The $105 difference between our strikes exceeds our net debit of $104.50, ensuring that we do not incur a loss if the stock price rises sharply. This comparison highlights the stark difference in capital requirements. Whether looking at Meta or Microsoft, the poor man's covered call allows for the control of 100 shares at a fraction of the cost. This efficiency is the cornerstone of the strategy, enabling traders to deploy their remaining capital into other opportunities while maintaining similar upside exposure. When comparing the PMCC to a standard covered call, several trade-offs emerge. While the PMCC offers significantly higher percentage returns due to leverage, it does not provide dividend income and carries a higher risk of total loss if the stock crashes. Conversely, standard covered calls offer lower leverage but allow the investor to retain the underlying asset even during market downturns. We must now address three critical risks, the first being the gap-up risk. If a stock's price jumps significantly above your short strike overnight, the short call's value will increase rapidly. To protect against this, you must always verify that the spread width, the distance between your long and short strikes, is greater than the net debit paid at the time of entry. The second critical risk involves the erosion of extrinsic value. Because a LEAPS option contains significant time value, a stagnant stock price will lead to steady decay. To counteract this, it is essential to remain disciplined in selling short-term calls every 30 to 45 days, using that premium income to offset the natural theta decay of the long position. The third risk is delta imbalance. As a stock's price drops, the delta of your LEAPS position decreases, meaning it becomes less responsive to subsequent upward movements. This creates an asymmetric recovery path where the position may not fully recover its value even if the underlying stock returns to its original price level. In summary, the three primary risks, gap up, extrinsic value decay, and delta imbalance, require active management. Ensuring proper spread width, maintaining a consistent selling cycle, and understanding the nonlinear nature of delta are the keys to mitigating these inherent dangers. Despite these risks, the primary appeal of the poor man's covered call remains its ability to generate recurring income. By systematically selling short-term calls, a trader can continuously reduce their net cost basis, potentially reaching a point where the original LEAPS position is fully financed by the collected premiums. Looking at an annual projection for Microsoft, we see the power of this income stream. Selling 8 to 10 cycles a year could yield up to $7,500 in total premium. When compared against the initial net debit of $10,450, it is clear that a significant portion of the entry cost can be recovered within the first 12 months of the trade. To recap the advantages, the PMCC offers unparalleled capital efficiency, consistent recurring income, and leveraged upside. Furthermore, it provides a defined maximum risk, as your loss is strictly limited to the initial debit paid, providing a level of protection not found in naked strategies. However, we must also acknowledge the disadvantages. The lack of dividend income is a significant factor for long-term investors. Additionally, the risk of a total loss during a market crash is higher than with outright stock ownership, and the strategy requires a higher level of active monitoring and technical proficiency. This visual comparison further illustrates the structural differences between the poor man's covered call and the traditional approach, emphasizing how the substitution of a LEAPS for equity changes the risk-reward profile of the trade. In conclusion, the PMCC is best utilized in mildly bullish environments for high-priced stocks when volatility is low. It should be approached with caution during high-volatility events like earnings, and it should be avoided entirely if you have a bearish outlook or require the stability of dividend-paying shares. Finally, please take a moment to review this disclaimer. The information presented today is for educational purposes and does not constitute financial advice. Trading options involves significant risk, and it is essential to conduct your own due diligence and consult with a professional advisor before making any investment decisions.